I don't think the headline number has too much to do with what's going on in the market right now. You're going to get fewer and fewer job creations this late in the economic cycle. Besides, there could be some weather-related details in there that may have impacted the number for last month. The real issue for the jobs report number for me was the wage growth. So we're continuing to tick wage growth close to 3% year on year, and that's really what the market reacted to today. And reflecting and echoing what Bob is saying, and I know Rick is going to talk a lot about this, this is all about rates going on right here, right now. But what we did pick up yesterday and what we saw today is that all of the major averages got oversold in our work. And what was really interesting is the S&P 500 bounced off the 50-day moving average. The Russell 2000 bounced off the 200-day moving average. And we would expect to see that when we have oversold conditions. So last point I'll make is I think that, equities will start to trend back a little bit. I think rates will continue to tick higher. They'll probably move a little sideways. What will be interesting is to see what happens on Monday when the bond market is closed. Will that give enough breathing space for equities to try and make some gains back?
Michael Jones from Riverfront Investment Group is now able to join us as well. Although, Michael, hold for 1 second. Rick, I'm going to come to you next. Been following all of your coverage on the move in rates, not just today, but this week. But I'm also interested why we haven't seen a similar reaction in the US dollar. Flat again today, up a little bit on the week, but not much given the move in rates.
Well, I think part of that could be attributed to what's going on in the equity markets. And I also think a lot of it goes to the notion that the dollar is, for the most part, in heavy demand around the globe. The problem is with the interest rate differentials, A, it could be a bit expensive. B, if you want to take on that expense in a dollar-denominated position, especially if you're a foreign investor, the hedging costs can be a bit prohibitive, not so much on the volatility side, but just on the notion that everybody is trying to accomplish the same thing, and the ante has gone up. I personally think the other issue is the euro currency itself. You can only swim so far in a circular pool, Wilf, and the notion that, over 50% of the dollar index is Eurocentric really kind of gives us almost a false view of the dollar in certain ways. But I would contend that ultimately, as we get closer and closer to the ECB trying to deal with the remnants of its policy as it's cut its purchases in half, that the euro currency starts to get much weaker than it's currently trading. I think you'll not only see that reflected in the dollar index, but I think you'll get an extra move in that regard. I think the dollar index is actually quite stable here, and the more I watch it trade, the less I am inclined to think that there's any significant downside on the horizon.
And Rick, you watch it closer than most. Michael, to come to you, the other big factor this week, of course, aside from rates, has been China. And you've just got back from a trip to Asia. Update us on how you think China's handling the move in rates, the trade war, etc.
Well, I think the real message from China right now is they are losing the trade war. And it really doesn't matter if President Trump comes to an agreement with China tonight. It's not really going to change the trajectory in the Chinese economy. Companies are waking up to the fact that if you source all your production in China and there's a trade dispute with the U.S., you can lose access to your products. You can have to pay giant tariffs in order to sell into the U.S. They're realizing that the notion of China as the world's factory floor is fundamentally flawed. It's too risky to source all of your products from such a geopolitically controversial country as China, and they're looking to diversify out of China. That's going to depress investment spending for a long period of time, and it's going to be a big headwind to Chinese growth.
Keith, do you think any part of that is the reason that we're seeing the big tech names sell off, some of the worries from the idea that those chips were installed in these computers and there's some spyware going on?
Well, that's part of the story, but I think also the...
I'm sorry, hang on, just Keith here.
Sorry about that. I think, but the big NASDAQ names, the big tech names needed to sell off. I mean, they'd had such a run, and they were really getting overextended to the upside. Yeah, exactly, and they were going to pull back, and that's some of the effect that you're seeing in the broader market. Certainly, the story with China will have an impact, but that's not really the story for me. It's just an overvaluation on what people are looking at inside of those names.